Okay, welcome everybody to today's webinar, our final webinar for the year. And so I thought it was timely to do an SMSF year in review from a webinar point of view. And it's actually when you start to do it this way and try and go back over what the year looks like, it's crazy how much sort of didn't happen in the first 6 months, and then in the final 6 months of the year, everything's gone bang, and we've had a lot of stuff to contemplate, and a lot of stuff sort of introduced for us to work through some processes. And one of the comments that I'll be making today is in relation to, for those of you that attended last month, I started to talk about the legacy pension regulations and how they're introduced. And I probably made a comment along the lines of saying, let's not have too much hope because they're linked to Division 296. Well, I guess something that took us all by a bit of surprise was over the weekend, or just before the weekend, the government lodged those or registered those regulations. So they are in force now. So I'm going to touch on those shortly. But let's kick things off and talk about the year, because there's a few things worth noting for us, and some things that I guess are frustrating for us as well with regards to self-managed funds. As always, a disclaimer, particularly as I said, normally, as you know, I mean, I tend to skip over disclaimers pretty quickly and recognise that people need to take responsibility for what they do from an action point of view. But no more is it relevant than when you get a scenario where so much is occurring within such a short time frame, and things change and people's positions change on a lot of things. So the disclaimer is always very important on a day like today. So what I'm going to do, I'm going to run through the major events. I'm going to highlight a number of cases. I'm not going to spend any time really on them. I've spoken about all of these at some stage through the year, but highlight 6 cases that target different areas, one to do with one around estate planning, one around investment related transactions, and one around contributions, just to show that we're still in a world where we see a lot happening in this space, and more occurring in the legal sense, which is defining how we act in the SMSF space, which is good, unless of course you're the cases that are being spoken about. But it's good because it gives us some boundaries to work within. Then I'm going to give a bit of an update on the current state of legislation. Again, over the weekend, it's changed as far as how much legislation we're waiting on is reduced down to one pretty big ticket item. Then I'll finish with a NALI, a contribution, and a pension update. So these 3 topics have had rulings released this year. I spoke about the pension ruling last webinar, so I won't sort of go over all of the facts again, but just really sort of reiterate the key ones, because what it really leads to for us is where we're heading strategically moving forward, and 2025 sort of, I guess, looks like it's going to be an interesting year, because we know that it's going to be a federal election. And whether that means there's going to be a change of government or not, none of us really know that. We can all have our opinions. I'll hold mine to myself in that regard today, but certainly we'll see that it's no doubt that in the landscape of our political space that we're only going to continue to see more and more power being given to crossbenchers in the Senate. That's certainly probably one opinion that I will share in that regard. And that means that, particularly in light of some of the legislative changes that have occurred around the objective of super, it means that there's going to be a lot more negotiation needed, and so policies, I think, will probably start to be, or either at the total extreme, because you're pandering to the extreme parties from a political point of view, or we'll just only see minimal sort of changes that'll come in, and not so much from a significant point, until there is one party that has power or balance of power or at some point in time. So we'll have to sort of see where that progresses to. But if we look at the year, as you can see, I've kind of tried to break it down from a timeline point of view into the significant events. And when I went back and looked at the first 6 months, there were certainly some cases and a few other things there, but from a regulatory point of view, we didn't see a great deal of activity. We obviously had a very quiet federal budget from a superannuation point of view. We did have the stage 3 tax cuts that were talked about at that point, and a lot of the budgetary measures were just reiterating measures that had previously been discussed. So we didn't see a lot happening in the first 6 months of the year, but then basically from the end of June until now, we've seen a flurry. Now, again, a flurry, let's define a flurry in Commonwealth government terms as 5 or 6 major events that are going to impact us, which is what we've seen in this case. We've seen a flurry of events occur where we've had releases from the tax office, we've had legislation passed on a couple of occasions there, we've had new legislation introduced and subsequently passed, and then we've had old legislation that has just continued to wait for passage, hold up, I guess, a lot of our strategic thought processes around Division 296. But in the meantime, we've also seen rulings from the tax office. Our two biggest non-SMSF superannuation related rulings. And I say non-SMSF because they're both tax rulings. The pension ruling and the contribution ruling are both tax versus SMSF rulings, but they largely impact self-managed super funds more than the rest of the industry because of the closely held nature between trustees and members. So, the fact that we've got a finalisation of the pension ruling is a positive. Not that the measures within the ruling were positive necessarily, but at least we can move forward with that. We've now got a draft ruling on contributions and what a contribution is and when a contribution is made. And again, there's some issues within that ruling that we're going to have to sort of monitor once the consultation period finishes. So there's consultation open till the end of January on the contribution ruling and the non-arm's length expenditure ruling. And again, all these matters have taken so long to get to this point. The gnarly measures were introduced from 1 July 2018. 6 years later, we get largely resolution, but not quite resolution because we're waiting on that ruling. The pension ruling, 2013 ruling, we've been waiting on since 2017, and same with the contribution ruling, waiting since 2017. So it's a fairly significant time frame that we've been operating under certain perceptions, which potentially now change as we move forward. So, as I said, a quick introduction to, or a quick sort of overview of a couple of cases in each sort of subject matter, just to remind us about getting things right ultimately, or where we see issues within the industry. And from a contribution case point of view, we had a number of cases where contributions were made in 1 year for varying reasons, and the taxpayer looked or asked the tax office to move or to either disregard for cap purposes or move those contributions to a different year for contribution cap purposes. In both sets of circumstances, the ATO said no. Right? Now, what that really highlights is that in these situations, they're retrospectively asking for an event to occur. What we know is, from an administrative point of view, the more we act prospectively, and so with contributions, and I've spoken ad nauseum about the use of contribution reserve, so making contributions in June and then using the ATO's very own system of asking for allocation pre-lodgement, so reallocation of those June contributions to the following year. The more we sort of push that down people's thought processes with regards to an opportunity that is available to them, the less cases like this we're going to see. So the more that our clients are in recognition of when contributions are being made and what their caps are, and therefore the ability to potentially reallocate to a following year, then the better the circumstances. Of course, we can't always do that with regards to employer contributions, and these were linked to employer contributions, but it's a key message that we need to try and make sure that we get right. From an estate planning point of view, the two cases that we actually had some really good cases the previous year. These two The Bella Health, the Van Camp and Bella Health one was an interesting one, primarily because it talked about the loss of capacity and whether or not an individual had capacity to make a death benefit or binding death benefit nomination, and particularly in this instance to change a binding death benefit nomination, which had previously distributed proceeds to his estate, and in these circumstances were making a change to allocate the money to his spouse. And so, this then relied on input from medical parties there as to whether or not the medication that he was on at the time was deemed excessive or otherwise, to determine if he had mental capacity. And what was interesting in this was they were looking really at the medication from a timing point of view, because in the same time frame, like within sort of days of all this, the same client had made significant changes to his will and other things as well, and none of that was up for dispute. Now, it was interesting that it was the executors of the will that were disputing the nomination, because the money was, of course, now going to the spouse rather than to the estate, and that's where the problem was created. So, it was a big case to work through in that regard. And then this other one, Gosh versus Gosh. And Gosh is probably the appropriate way to describe this case. This was two brothers, or the way you read the case, you believe it's two brothers, because it's clearly two brothers that don't get on very well, and there's a lot of strained issues between them and their parents, who had both passed away, and ultimately one brother had assumed control of everything, a company that was run previously by the family and by a self-managed superannuation fund. Now, the interesting thing was the applicant, being the other brother, was applying for that first brother to be removed as a legal personal representative, because ultimately they seem to be creating their own narrative about the circumstances, and spreading a lot of false stories about the applicant with regards to one thing, killing the parents, and other things. And so it was an interesting sort of set of circumstances, working through a number of facts to determine that, again, ultimately the appointment of who looks after a self-managed super fund when the members pass away is such a critical issue. And so, whilst both of these cases are quite quirky and have many weird elements to them, both of them are quite staggering reads. What they really hit home for me is that when we're talking about estate planning in the SMSF space, we really just have to make sure that that we're getting not only our LPR appointments right, so understanding who can be trustee when something happens to the members of the fund, but we also have a better appreciation for the requirements within our own fund of how binding death benefit nomination rules work in accordance with the trust deed, so that we can potentially alleviate a number of these issues that arise. And generally, all of the court cases that we see with regards to estate planning are because either there's no documentation, or the documentation is not clear in what is providing, or people are acting outside the guidance of that legal documentation. And so, if we get the process right, and the more people that we incorporate into that process and who understand the process, the cleaner the estate planning situation is going to be for a fund. And then the final ones that I wanted to briefly touch on were our related party-based cases. And we had our merchant and the Commissioner of Tax, and then we had our Coronica. And of course, merchant, for those that remember it, is the Billabong case, where Mr. Merchant was one of the founding parties of Billabong, and he transferred some Billabong shares from his family trust to the self-managed superannuation fund. And this, of course, is not a breach of Section 66, because we can acquire listed securities from a related party. So it's not a breach of Section 66. It was deemed to be a breach of the sole purpose test, and a breach of the financial assistance provision, Section 65, because the transaction resulted in a significant tax loss for the family trust, which of course was offsetting a very significant capital gain. We're talking like gains of 80 million and losses of 50 million. So they offset each other once you did your CGT discounting and things. And so the significance of the loss created in the trust was more than the purpose of transferring those shares into the self-managed super fund to provide for retirement benefits. Because again, for those of us who know the history of Billabong, it hasn't been or wasn't a successful company from a stock market point of view. And so the value had diminished quite significantly. So the upshot of this whole scenario, because of the value of the transaction, I think because of the value of the transaction, the commissioner disqualified the trustee, or took the action to disqualify the trustee. The trustee appealed that disqualification and then was subsequently successful in his appeal, because they said that his actions weren't necessarily going to be a guiding force to other parties, or weren't going to have any implications on the general public. It was an isolated single event, and he was acting on advice. And that advice was that under Section 66, you can transfer these assets to your superannuation fund. So ultimately, this person was provided with the capacity to act as trustee of the fund, continue to act as trustee of the fund, with some guidance in place from the regulator. Versus Coronica and the Commissioner of Tax, who was a tax agent themselves. So Mr. Merchant was not an SMSF professional as such, versus Mr. Coronica, who was an SMSF professional, if we use that term rather loosely in this situation. And there was multiple scenarios of acquiring assets from related parties, or attempted acquisitions from related parties. There was multiple examples of breaches of market valuations and determining their own market valuations to ensure that the investments were under 5% of the total assets of the fund. There was no question about the validity of all of the previous existing assets in the fund. The fund itself was I'd say relatively compliant, except that it was running a loan account between the members' business and themselves, where they were effectively running money all through one account or one journal, and then just sort of balancing it off at the end of the year. So there were certainly some practices that were inappropriate and led to, in essence, financial assistance. But there was lots and lots of related party events that led the commissioner to breach the fund under financial assistance, acquisition of assets from related party, in-house asset rules, sole purpose test, I think. So the whole gamut of them. And then Mr. Coronica appealed that because he was also disqualified. And he appealed the disqualification and said, my case is just like Mr. Merchant's. And the tribunal said, your case is nothing like Mr. Merchant's. There's just the multitude, the number of events over multiple years that you have undertaken these transactions, and unlike Mr. Merchant, who saw the ills of his way in as such, Mr. Coronica still felt basically that he was doing the right thing, because that's how he interpreted the law. His interpretation on some of the sections was quite fascinating. Again, if you've got some spare time over the Christmas period, you want a good fun read, then all of these cases will certainly provide that for you. So let's move on. Again, all of those sorts of things, particularly related party transactions, what those court cases and appeals sort of take us down the path of is ensuring that you do your research before and can validate your research. So validate your acquisition of assets from related party, validate your valuations, ensuring that you've got market valuations, third-party valuations, other things to be able to support transactions, rather than just making yourself the sole source of information to say, yeah, I can do this because that's the way I interpret things, is generally problematic in the SMSF space. And again, from a contribution point of view, understanding the timing rules and the opportunities, as I said, the use of contribution reserves, if you're going to use them, it's a prospective transaction, not a retrospective transaction. So you have to understand the consequences of why you're using it there. And from an estate planning point of view, ensuring that we get everything right. So from a legislative and policy point of view, we now have a legislative position or a final position on the objective of super. Now, that objective of super, again, to preserve savings, to deliver income for a dignified retirement alongside government support in an equitable and sustainable way. This is an we talk about these other rulings that have taken so long. The concept of the objective of super was brought in when super reform came in, and so the legislation was first introduced and then disappeared back in 2016. We've then had a second crack at it here. The government have had a second crack of it. This time it is received as part of the government's big guillotine motion where they bundled, 30 pieces of legislation together on the final day to give it all a timed debate and then a voting. The super objective bill has passed. Now, what it means is that any future changes to legislation that relates to superannuation must be judged against their objective or against this objective. So if we're looking to, and I'm just going to say housing policies for the sake of the presentation, not for any other purpose, but if a government was to say, right, let's look at the access to super for housing beyond First Home Super Saver Scheme or something like that, then you have to go and look at it from an objective point of view versus this concept of preserving savings, etc., from dignified retirement. Now, one of the key messages there is preservation and being able to access money early for a purpose other than to provide for retirement. Where does that sit in the confines of preservation? Well, that's for debate at a further time. But of course, the issue is that there's no enforceable right in respect to whether or not you comply with this measure. So it's a bit problematic in that it is kind of there. It's there to guide us, or guide policymakers in regards to their policies that they make. But there's nothing that's necessarily going to come down on them if they don't follow that process. So it'll be interesting to see sort of how often this is referred to from a piece of legislation. I think many will suggest that kind of it's a nicety, but it's not necessarily going to change political behaviour as such. And one thing, of course, I'll highlight here, which I do always when I'm talking about the objective of super, it's nothing to do with trustees. So from an SMSF point of view, we're still operating under the sole purpose test, right? So sole purpose test is fund behaviour, right? Objective of super is effectively policymaker behaviour. And so we need to understand where that sits in that regard. Division 296, obviously the biggest ticket item that we've all been talking about for nearly 2 years now. There was an attempt to have this as part of the guillotine measure and debated rather quickly. It was never going to succeed that because there is a fair bit of dissent within the Senate with regards to it, and I think it should be acknowledged that the SMSF Association have done a wonderful job. I think Pete Burgess has probably spent more time in Canberra than Adelaide this year. But the SMSF Association has really lobbied hard with the crossbenchers and others in reference to the unfair nature of this act, in essence, in regards to the issue that for most of us is the problem with it, and that is the theoretical taxing of unrealised capital gains. And so, to get to the point where this legislation, yes, it's passed the House of Reps, but the fact that it's now stalled in the Senate is quite a positive measure. And I'll bring up a slide in a moment that sort of highlights some of the key issues now that the government face with regards to Division 296. And then the draft regulations on the legacy pension conversions and the ability to remove reserves. Now, I haven't, because it's only sort of happened in the last little bit, I haven't updated the title of the regs. I've just got the link to the original draft regulations. However, the final regulations, which largely mirror these draft regulations, were registered on the 6th of December. So that means that they come into effect from the 7th of December. Now, the thing about regulations like that is that they are open now to a process from a regulatory point of view. They're open to a process which allows, firstly, they have to be tabled in Parliament, in the Houses of Parliament. So they can't be tabled until the Houses start sitting. So the House doesn't sit until February, right? So they've got 6 days from 6 sitting days to have them tabled, right? And then there are 15 sitting days for these measures to be effectively, for a motion to be put to disallow these regulations. Now, the key thing here is that when you go through the concept of how legislative instruments like this work, it means they are enforced now until such time as they are disallowed due to a motion being raised. Now, unlike legislation so an act that hasn't been passed, so when a bill is presented and the government is dissolved through calling of an election, then all of those bills, they are also dissolved at that point in time. Because this has now been registered, as far as it's registered in the legislation register, it is in force. So the 15 sitting days that I'm talking about for a motion to be passed includes any of the existing government period. And then if an election is called and government is dissolved, then that sitting days just picks up from when they start to sit again. So we actually may see these regulations not cleared from a final point of view until we have a new government. But what that actually does is just extends the period of time until these regulations may become invalid, which means they're valid right now. So anybody that has a legacy pension, which is a complying lifetime pension, a complying fixed term or life expectancy pension, or a market link pension, any of those 3 pensions are now fully commutable, right? So people can stop those pensions immediately, right? Once stopped, then and this doesn't apply to market link pensions, but once stopped, the reserve that supports those pensions can be allocated 100% to the member. So there's a significant requirement, and that is that the member who is receiving the pension must be alive, right? So there's other issues associated with death benefits, right, and allocations when the member has passed away and the reserves are sitting in the fund. We might have to take up a separate fight about that, right? However, if we've got a pensioner still alive with one of these pensions, right, then they can stop that pension and allocate all the proceeds, including the reserves, to themselves. Once they've done that, they can start an account-based pension if they want. They can leave the money in accumulation if they want, and they can take the money out of super. This is a significant measure for those that have these pre-2007 legacy-based pensions. Beyond the ability to commute those pensions, we've also seen a change to the allocations from reserves. And so most people understand that when there's an allocation from a reserve, that money would count to the concessional cap unless it was done on a fair and reasonable basis and represented less than 5% of the account balance, or it was an allocation from a reserve supporting a pension to ensure that the pension liability was met. Those conditions still apply, except now it's measured against the non-concessional cap. So anyone with a reserve that was created for any purpose inside a self-managed superannuation fund can make an allocation now, and that allocation will be counted against the non-concessional cap. So it gives us the capacity to allocate at a minimum up to 4 times the concessional cap. Now, appreciating that some people have no non-concessional cap because they've got more money in super than the general transfer balance cap. Well, if they make an allocation, then they're in excess, and then the money must be pulled out under the excess non-concessional rules, and there'll be a tax liability on the associated earnings. That's a significant win compared to where these reserve measures were announced originally, where it was just a flat tax that was going to be payable on any allocation from reserve. So even in the worst case scenario now, the worst allocation from a reserve is only going to result in marginal tax on the associated earnings, less that 15% rebate. So that's pretty significant. But to take it one step further, a lot of these pensions, like your life expectancy pensions, have ceased. The fact that they've ceased and those reserves still exist, those reserves are still considered to be pension reserves, and they can be allocated without a tax impost, without counting towards any cap, to the original pensioner. Now, that includes flexi pensions, right? So flexi pensions are not incorporated into the new commutation rules because they are already commutable. However, allocations from reserves from pensions that were flexi pensions can be made and do not get counted towards the non-concessional cap moving forward. So these regulations are pretty significant in what they provide for. There's a lot to still play out with regards to social security and debt waivers and asset test exemption and those sorts of things. So I'm not suggesting by any means that everybody's just going to go out and commute and be happy, but I think for a lot of people where there's been an inability to commute and a desire to commute, that inability has been removed, which is pretty significant. So with the Div 296, this calendar is relevant for those legacy pension reserves as well. This can't be debated now in the Senate until at least early February, right? So this is all going to hinge on when the government call an election, because if the government call an election early, right, because they don't want to go to a federal budget, so they've earmarked the budget for March. If they don't want to take us through to a budget and rather would call an election early, we may not get those sitting days. They can call an election at any time from now. The last day that we can have an election is the 17th of May, and that's because of the Senate rules. So we've got a fairly restricted amount of time available for Div 296 to be debated if it's going to pass prior to a new government being elected. So it'll be interesting to see whether or not the government go away over this period and have a think about all the issues that people have raised, or whether they want to stick to their guns. And if they stick to their guns, then maybe we don't see Division 296 in its current format before an election. Fingers crossed in that regard, but we'll have to wait and see. But it's pretty significant where we're sort of sitting in that space. And they definitely don't have the numbers there. So that's the sort of the legislative update position. But as a result of the legislation that has received passage, obviously that's now gone on and impacted a number of other key issues for us. And the first one is that non-arm's length expenditure. Now, I've definitely been speaking a lot about this over the last 2 years. But what we've seen is that the legislation, the gnarly legislation, received royal assent from the 28th of June 2024. So what that now leaves us with is this known concept of the general expenditure, right? The gnarly being applicable to 2 times the level of the general expenditure breach, right? With being a lesser of factor, so the lesser of 2 times of the general expenditure breach or the total taxable income less assessable contributions, right? Which is a far better outcome than all of the income being taxed at 45%. I think we can all agree with that. Of course, what this legislation didn't impact was the specific fund asset expenses. So if you've got an expense linked to a specific fund asset, then that has always been subject to the gnarly expenditure rules all the way back to the 1st of July 2018. Nothing's changed in that regard. But what it does mean now is, one, we needed to get an update to the LCR, which provided all of the examples based on that general expenditure applicable to all of the fund income. We've now seen that draft ruling released, and ultimately just highlights all of the key changes that this 2 times expense factor pushes for us, right? We will need to see some more things come about, because what we've already seen released is TD 2024/5, and that is the resulting CGT situation, where if you've got a specific expense, right, and you've got an asset that is subject to non-arm's length income, and so therefore you make a non-arm's length capital gain, that non-arm's length capital gain is merged with your other capital gains to then determine what the net capital gain is, meaning the bigger the gnarly gain, the bigger the consequences are on arm's length gains being tarnished with that 45% tax liability. A very minor non-arm's length gain will have a very minor impact on arm's length gains. But if you've got any clients that have tarnished an investment because it might be an LRBA or something else like that. If they've undertaken property transactions not on an arm's length basis, and they sell that property for a significant gain and then go and sell off some listed securities, then the upshot of that is that a lot of those listed securities are ultimately going to be tarnished with that non-arm's length tax amount of 45%. So, this this measure, it's the best of the worst outcomes that we could get, like the 2 times factor. And again, the association, continually argued that that we should not have a piece of legislation that is, particularly in light of Div 296, we should not have a piece of legislation like the NALI law, which distinguishes between self-managed super funds and APRA funds, right? But the NALI law is exactly that. It's only applicable to self-managed and small APRA, right? But it is problematic with regards to the fact that we've got to understand the concept of whether something is undertaken in capacity as individual or trustee, right? If it's undertaken in the capacity of trustee, then there's not going to be any NALI. But if it's undertaken in our capacity as an individual, then we have to factor in Section 17B and trustee remuneration. 17B requires arm's length transacting if you're qualified to do it and you provide that service to the public, right? But in some circumstances, you're not going to fit under the umbrella of Section 17B, and therefore, if you're going to try and do the work and pay yourself for the work, you might have a SIS breach versus a tax breach, and it's going to create all sorts of problems. So the gnarly stuff is not going to go away overnight and be easily solved. We need to make sure that we've got things like discounting policies and that in place. And when we look at this process, we had our compliance relief on the general expenditure stuff, which expired on the 30th of June 2023. Right? The new legislation, right, is effective from the 1st of July 2024. Now, it applies to expenses that have been incurred all the way back to 1 July 2018. So we've got this 12-month gap, which is the last financial year, where if we weren't applying discounting factors, right, if we weren't sort of following on through the process to make sure that we were trying to deal on an arm's length basis in all transactable events, then we might find that there are some NALE expenses, general expenses, that get captured in that sort of that period between the legislation being applied, and if that occurs, how are we going to deal with it from a fund point of view? I still don't think necessarily that NALI is going to create too many issues from a general expenditure point of view, but I do hope that we take the opportunity to really sort of drill down with our clients and highlight you can't just do things, and you definitely can't just do things for free for your fund, right? Unless you've done your research as to whether you're doing it in your capacity as trustee or whether you're doing it in some other form of capacity. So it's a fairly significant issue there. And we've got the ruling that was released, the updated ruling, LCR 2021 to DC. It's open for consultation until the end of January. Largely, like when you read through it, and some of us have read through this ruling so many times in the previous form and the current form, ultimately what it does is it replaces all of the previous references and examples with updated based on the 2 times expense factor. So it there might be some things that are subject to wording change and other things that come about from it, but largely it now just represents or reflects what the legislation is actually providing for. So we'll see what comes out of that consultation period. Contributions in review. This is obviously a little bit more, I guess, I don't use the word tricky, but I'm going to, because I can't think of another word to say at the moment. So it creates a bit of a tricky situation for many of us to contemplate. So just before I jump into the contributions, got a question. Do I have a list of things that can create gnarly issues, like you mentioned, whereby people do stuff for their fund and pay themselves? Well, yeah, look, so it's, I guess the list, there's actually a list within the ruling and the legislation. So doing things like preparing your accounts, preparing or looking after fund investments. So managing an investment portfolio, buying and selling investments for the fund, property management fees. Audit fees shouldn't do it because you can't do independent. You have to do independent audits, but of course you can deal with an auditor on a non-arm's length basis if you so try, based on relationships, and that causes all sorts of other problems as well. But they run through like accounting fees, actuarial fees, audit fees, investment management fees, property management fees, legal fees. They're the sorts of areas where costs would be attributable. But for me, that's easy in regards to the general expense nature. Then you've got other areas such as property-based investments where you've got maintenance-based fees. So, if you're fixing the fencing, fixing the guttering, or just doing some plumbing work. I fixed the taps in the house the other day, one of my many skills, but in doing so, I broke something else within the plumbing. So now the pipes are leaking. So clearly I shouldn't have done that. Luckily, it's not owned in my self-managed superannuation fund, but I have to go and get somebody else to come in and work out what I've done from a tap point of view. So self-managed super fund trustees, unless they are plumbers, right, should not be doing the repair work on any of the plumbing requirements. And if they are a plumber, then ultimately they really should be either paying themselves exactly the same way they would be paid by a normal client. So the self-managed super fund will pay them exactly the same way as a normal other client, or the value of the transaction is so insignificant that it's not going to matter. And this is, I think, a bit of a problem, and that is that they use the example, I think, of Trang within the ruling and owning two investment properties, and one where they go and just replace something in their own time, and it's fairly minimal from a costing point of view, versus reinstalling hot water systems. And the installation of the hot water system, where if they don't charge there, would definitely be a gnarly event, but changing a few washers or something to that sort of level would be fairly insignificant. And I think this is the problem with it when you're talking about expenditure. What is the threshold? What is the threshold of what we can and can't do? Because in the scheme of the fund, if you're doing something which ultimately has $100 worth of value in hundreds of thousands of dollars worth of fund, is that really significant? And I think this has been the argument all along. In most instances, if the fund's not paying for it, then surely from a superannuation point of view, and certainly from a SIS point of view, then that is for the betterment of the superannuation fund, and so it's therefore for the betterment of the retirement. But then once they link it back to the income tax requirements, that's when it becomes problematic. So, it really is an issue that we're trying to move away from, but we just need to be mindful there. But the ruling does stipulate a number of those conditions. So with the contributions, again, as I said before, the contribution ruling is been something that's been waiting for since 2017. A lot of that was because we removed the maximum earnings base, like the 10% substantially self-employed rule, from 1 July 2017. So the ruling already needed updating, but the rest of the ruling looked fine to us, right? Because it talked about how a contribution could be made, and it talked through things like in specie contributions. And the industry has operated well and truly in a space where we know, and we've always known, and certainly it's been drilled into us for the last, for me, 20 odd years, that we're dealing at market value. Now, clearly some people still don't act at market value, and that's a problem, and those people need to be dealt with, right? And their funds need to be dealt with. But I don't think it's that widespread that it requires such wholesale changes as this ruling change has introduced, where they start to talk about in specie transfers, and they start to sort of split the language for how we make a in specie transfer. So with this, the ruling, they've sort of said a contribution can be made via an in specie transfer. So therefore, if you do a transfer of an existing asset to your fund, that is an in specie transfer, and it will not attract gnarly, right? Now, that assumption is made on the fact that Section 66 requires you to do that transaction on a market value basis, right? So the standard in specie transfer, in accordance with Section 66, has to be done at market value. So therefore, there's not going to be any non-arm's length income issue associated with it. That's all well and good to think that in the environment that we operate. And I think we all like that approach, because if you got the numbers wrong from a market valuation point of view, you would just correct them and update the value of the contribution, right? What this ruling is now stated is largely that if the transfer of asset is actually an acquisition of asset, so it's actually under a contract of sale or a contract of purchase contract, right, and market value is not paid for the asset, we can't then treat the difference as an in-specie contribution, and that transaction will trigger a non-arm's length income event, right? So we can, under a contract, determine, so at the point in contract, by the settlement statement or however you would word it, you could say that the super fund is paying X amount for the asset, like the market value is A, right? So let's say that market value is $1 million. The super fund will pay half of 700,000 and the member will contribute 300,000. If you stipulate that as part of the settlement process, as part of the contract, then that's going to be fine. But if you say that the property is worth 800,000 and the fund is going to pay 700 and contribute 100, but then it's determined that the value is actually $1 million, then you've got a non-arm's length income problem. And so for me, what this is actually doing is it's really creating a lot of confusion around the whole contribution rules and what is and isn't going to be non-arm's length income, and particularly what is a contract, right? Because, and again, the example that I provide here is basically explaining what I've just sort of highlighted there from that example point of view as to something that would or wouldn't be non-arm's length income in that regard. But the problem that I have with this, and I really hope that this is addressed through the consultation period, I'm certainly looking at ways of how to potentially try and address it with the regulator, is, and many of you may have heard me talk about this before, but if we're doing things such as off-market transfer forms, is that off-market transfer? Is that a contract, right? Is that the definition? Does that satisfy the definition of a contract from an acquisition point of view? Because if the consideration that we list on that form does not match the share value on the day that the form is executed, right? So we fill in the consideration, we fill in the number of shares that are going to be transferred, and then the trustee and member sign the form on another date, and the value on that date is different to what we put in the consideration. Have we then just created a non-arm's length expense for the fund by paying unders for those shares? Now, I would hope that we're not in that situation, but I fear that the way that the ruling is worded might trigger an easy way for the regulator to capture that as a non-arm's length expense. And so I want to get some clarity around things like, we understand the tax officer's position as to when an off-market transfer occurs, and they say the off-market transfer occurs on the day that the form is executed. So beneficial ownership changes on that date. That's when the effectively the contract has occurred. But, you know, are we still able on that day to rectify the consideration that was on that form and treat the difference as an in-specie contribution if there was never any purchase associated with it? If the whole thing was always going to be a contribution, can we just make the contribution the value of the shares on that day? Getting clarity on that to me is quite a significant issue, because I think that's going to be problematic. So, you know, that's the whole contribution ruling, which again is also up to consultation to the end of January, is fine in what they've removed with regards to the maximum earnings base and other things, but there's some real issues for me around this in-specie contribution stuff, and I don't think they go away without clarity from the regulator, and at no point in time has the regulator really sort of highlighted, either through LCR 2021-2 or TR 2010-1, you know, that set of circumstances, and that is a far more common approach than a self-managed super fund purchasing a property not at market value. And so for me, that to me is something that we need to have addressed. The pension issue, so again, to highlight what I've spoken about at our last webinar, but just to reiterate it again today, because when we're looking at a review, this is going to have an impact moving forward. Many people would be now in the situation where they are looking at finalising funds at 30 June 2024. So we may be identifying minimum pension shortfalls that have occurred, if we don't have a process in place that identifies them prior to the 30th of June, which of course implore people to try and build processes to ensure that that they are reviewing minimum pensions prior to that date, and making it very clear now to clients. I mean, you couldn't have made it clear before 30 June because this ruling only happened about that time, right? But making it clear to clients, particularly moving forward, if you do not pay your minimum, then your pension will cease at the preceding 1st of July, right? That is a given for fund exemption, right? It will then be reported at 30 June for transfer balance cap purposes to say that it has ceased at that day, and you will not start receiving a pension until you consciously commute your existing pension and make an election to start a new pension. So we have this position now from TR 2013-5, where if you meet the rules in 1 year, you then fail, say at 30 June 2024, and you failed by greater than 1/12, then the pension will cease for both tax and SIS purposes at the 1st of July. No ECPI for the income year, and the new pension does not automatically start on that 1st of July date. If it's not until the 1st of March that you recognise it, then you will consciously commute. You'll make a decision to consciously commute that pension on the 1st of March, meaning you've extended that ECPI period from 1 July 2023 through to 2025, 1 March 2025, where the fund is in a taxable environment. And, you're then having to start a new pension on the 1st of March or whatever day you choose. And then you've got your pro rata calculation. So again, instead of working in an annual pension basis, you're working on a pro rata basis. You've definitely by this stage merged all of your pension and accumulation interests. And so there's definitely a big issue with regards to the tax-free and taxable status of that pension versus, maybe it wasn't such an issue with 1 July, but there's still a lot for us to work through with the regulator in this regard as we sort of move into the new year. And that is, when does that separate interest merge, right? Does it merge from loss of ECPI, cessation of pension? Does it merge from T-bar reporting date, 30 June? Does it go all the way through to the consciously commuting date? And again, I raise that because from a system point of view, from your accounting software point of view, you're going to have that as a separate interest. You're not, firstly, for the whole year, it's going to remain as a separate interest. So do you then go back and merge that back and roll it back? Do you go back and do pre-dated accounting to unwind that from the 1st of July the previous year? I wouldn't have thought so, right? But it may be that situation. Do you just do it from the 1st of July of the new year? Maybe that's the situation. But if you're consciously commuting, then are you stopping that interest on the day that you actually make the conscious commutation? So there's a number of key issues there. Of course, the other one is that from a T-bar reporting point of view, the value change from 30 June to the conscious commutation might result in not excess transfer balance, but less amount of money being able to be put into a pension. So you have to contemplate what that actually means as well. But then there's other areas such as grandfathering from a social security point of view, and how this measure is going to impact things such as death benefits and that as well. So there's a few things to be mindful of there. So look, a bit still to come out from that, and we hope that, particularly linked to transition to retirement income stream, that we get some further movement on tax determination 2021-6 and PSLA 2021-3, which we're talking about early release monies, and they're often referencing early release due to failure of the pension standards. So maybe that's one of the next items on the ATO's agenda. So what I want to finish off, last couple of minutes to bring the presentation to an end. I speak a lot about, and I think I may have spoken to one of our webinars earlier in the year on insurance in superannuation, and so everybody knows that a topic that is one that I talk about frequently is this future liability to pay benefit deduction. Now, interestingly, we had a private binding ruling from the tax office in the last sort of month or so, where the question was raised about whether or not, and this is a TPD benefit, so whether or not the decision by the member to roll the insurance proceeds from their self-managed super fund to another fund whether that would be considered a payment that was subject to the future liability deduction benefit being paid. Now, the upshot of that from the ATO was that a rollover is considered to be a payment to the member, right? Even though the payment to the member is then directed to another superannuation fund, it is considered to be a lump sum. And so what it means is that we can actually claim the deduction on the rollover of the proceeds. So in essence, it's not a bad sort of scenario from a strategic point of view to say, okay, well, if somebody's potentially going to be receiving an income stream and they're going to roll their money over to commence somewhere else, well, then they can actually get the deduction inside the super fund, leave the money in with those with accumulation interest, and then roll money elsewhere to start drawing down an income stream. It has its benefits associated with that. But also just to get that clarification on a matter that really from the tax officer's point of view, we haven't seen that clarification before is pretty significant. So, it's a deduction area that I've certainly spoken about a fair amount, and we have these videos online, Feeling Smarter, and you can certainly go and view those videos to look at a number of examples of how that might potentially work. But again, it all comes down to the choice. And of course, one of the key things about the choice is if you make the choice to claim the future liability deduction versus the premium-based deduction, then it's irrevocable and you can't go back and claim against the premiums for future premiums that are paid in the fund. This determination also went to the extent to say, if the commissioner denied the deduction under 295,470, would the fund still be entitled to claim under the premium-based deduction? And in this instance, the commissioner said yes, because it's an either or deduction. So that was a good bit of information to obtain from that as well. So that's just the formula for how the deduction is claimed. So the last thing that I wanted to touch on is 2025. And again, in an election year, we don't want to make too many forecasts about what's actually going to happen. But what we know right now is that the CPI figure for September 2024 quarter was 139.1. The CPI figure for the December quarter needs to be 137.4 for us to get an indexation of the general transfer balance cap from 1.9 to $2 million. So it would seem that we're there right now, unless some form of miracle happens and we have a reduction in the CPI figures at that point in time. I don't think any of us would suggest that that's likely to occur. Then we are going to see an indexation of the cap. And of course, an indexation of the cap gives us this capacity to contemplate contribution strategies based on a $2 million general transfer balance cap. It gives us capacity to put more money in pension if we haven't started pension yet. So it means that once these numbers are released, we start down that process of should we contribute in this year or should we contribute next year, all sorts of other things around money, knowing that we got the cap indexation last year as well. Of course, the only thing that might change that would be if a government made an announcement to freeze the general transfer balance cap. Now, of course, that conversation comes up on an annual basis when this number keeps progressing. People say, well, the government might actually freeze it. I wouldn't have thought in an election year that would be the wisest thing to do, and certainly not if you're going to go to an election and say we promise to freeze the general transfer balance cap from the 1st of July this year. Then they won't need to freeze the general transfer balance cap because they won't be in government on the 1st of July this year, is what you would assume. So I would think that the likelihood is that we expect to see that general transfer balance cap going to $2 million at a minimum on the 1st of July. So look, just to round that all up for us, it's really critical from an expenditure point of view, the stuff that I talked about at the beginning, that we start to not start, hopefully we're already there, but that we ensure that we're acting on arm's length terms with regards to not only our transfers and things, but any expenditure in the fund, and identifying, like the question raised, what expenses we need to be mindful of, but really drilling into that whole trustee versus individual capacity. In specie transfers, as I said, I've been banging on about them for a long time. I'm going to keep banging on about them until we get some sort of finality on the position from a regulatory point of view, ensuring that we're making our minimum and maximum requirements and are monitoring them during the year to make sure we don't go under or over, particularly for a TRIS, because for a TRIS, the ramifications are going to be far more significant. From a legacy pension point of view, and again, appreciating that there's going to be more market-linked pensions out there than, say, lifetime or fixed-term pensions. There'll be very few fixed-term pensions left. But, this is now an opportunity for us to go, let's get out of these items. Maybe we can stay or keep some money in account-based pensions. There are commutation risks associated with market-linked pensions from a transfer balance cap debit point of view. So you need to understand that to ensure that, or to know that you potentially can't put all the money back into an account-based pension. But it's about understanding all those issues associated with that as well. And if you've got reserves, if you set up reserves for anti-detriment, self-insurance, investment smoothing, whatever other crazy sort of concepts that might have been promoted by people like myself and others over the years, if there are any other reserves out there, we can look at them and we can start to look to allocate them against the non-concessional caps of individuals, and that will provide for significant outlays coming out of these problematic parts of legacy matters for self-managed superannuation funds. So noting that we've got lots of contribution and pension opportunities still available to us, one from an indexation of the cap, but two just from all these other measures that are out there. There's still plenty for us to contemplate moving forward. So look, that's it. Great to speak to you all again. Time for a break. Hope to see you all again next year. I've got to sit down with SuperGuardian at some point in time to work through our calendar, see if they want to continue to do these presentations. I suspect that that it is on their agenda. I've enjoyed doing them, but we always take January off with regards to the delivery. So our next webinar will likely be February. So keep your eyes open for that, and we'll send you through your CPD certificate and a copy of the presentation today. Other than that, if you can have some time off, enjoy your time, and I look forward to catching up with you in the 2025 year. So thanks for attending, and I look forward to seeing you all again soon. Bye for now.